Dilek, I think you have to tell the story of how you actually got here.
Oh, it was a nightmare. So Shafak is here. We were gonna come together, and we didn't get our visa till the last minute. You guys, actually, the Latitude team, Sebastian, where are you? Thank you so much. He made it possible. They called the embassy. And the other day, it wasn't still in our hand. They called again, and we called a really trusted friend in another city. He picked it up. He put it in a bus that we don't know. We had no clue. But he told them, I took your picture of your ID. Please give it to the right person. And we picked it up from Istanbul. By the way, I'm based in Istanbul. So it was a really different experience, let's say.
Well,
just 8 or 9 hours before we had a flight, I was able to know that I was coming or not. And I had 2 panels, so.
Well, we're delighted
I made it.
have you here. Quick introductions. Niko, do you want to go first?
Yeah, sure. Niko Elers from Finland. My journey wasn't as interesting. I took the ferry in the morning. We have this fund called Voima Ventures. We have offices in Stockholm and Helsinki, but also invest in Estonia, Latvia, Lithuania as well. 2 funds. We invest into deep tech, and my specialty is the sort of green investments and space tech. So any space tech entrepreneurs here, please talk to me.
Thanks, Niko. Dilek.
So obviously, I'm based in Istanbul, but I invest pan-European, let's say, and mostly help them to go global, mostly to US. I'm founder and managing partner of ScaleX Ventures, 30 million euro fund. I define myself as a venturepreneur. Before that, I was angel investing, VC consultant and operator in a high growth, it was Groupon that time, high growth company. You can get my age from there when they were growing fast. But anyway, long story short, engineer and also entrepreneur. So we invest in AI, deep tech, autonomous trucking, cybersecurity, developer tools. Yeah.
Awesome.
And if you are entrepreneurs in this space, please come to me or Shafak for sure.
Excellent. Okay, so I think we've had 2 wild years in venture. Valuations obviously through the roof, a lot of activity. Q1 data for Europe from Crunchbase obviously showed a slowing down. And, I think in the last few weeks, talking to VCs out in America and the US, it's definitely feeling like there's a massive change. I did a call with Andreessen last week, and it's like valuations at seed aren't so sensitive, but above Series B certainly are. Then looking to make sure funding for 36 months now. Obviously, we were seeing companies coming out twice in a year for funding. So without trying to be too gloomy, and I know Dilek, you're still quite positive. I think it's just a
positive, but yeah.
Just a little bit of reality check as to where are we heading? Is winter coming in Europe? What should we be expecting? Dilek, you're probably the least pessimistic at the moment. So, where do you think we're heading? What does the next 24 months look like, and how should founders prepare for that?
Mm-hmm. Obviously, winter is coming, but it all depends where you are. Are you from the Castic Black, or are you from the King's Landing? So, where are you in your journey? It really is going to affect, is winter coming or not, which means, are you burning a lot of money? Are you a growth stage company? I think it's going to matter a lot for sure. But there are also a lot of dry powder there, which means, for the VC wording, there are so many VC money out there to deploy, which means it has to be deployed in the next 3 to 5 years for sure. But look at, these are, obviously, I'm a realist optimist. On the realist side, we know that, even myself, I've been deploying money for the pre-seed and just for the team and potential. Now I'm are they gonna be able to go through this phase? So I have other checklists in mind as an investor to give you an idea. And are they gonna hit the product market fit with the money that they have in the hand? So these are gonna be important. And also, even though we have dry powder for the early stage, people are going to slow down, which means less money in the market to deploy. But obviously, for the growth stage, there's definitely a winter in the market. Like we know our firm has like 90% decrease last week. So these are reality for sure.
Yeah. Niko, what are you seeing?
So there's always money for good entrepreneurs and good deals, but no doubt the 2 last years have been extraordinary in a sense that you could even list a pre-revenue startup in Helsinki or Stockholm. I don't think that's coming back anytime soon. At the same time, I haven't seen any sort of, I mean, when you're talking about Q1, I thought about that and checked our deal flow, and Q1 was kind of slow, but now it's picking up again. So I'm not sure what to think about that. So we do see a lot of deals, and there is no change in valuations yet. So they have been kept growing at the moment, but now it would be a good time to sort of have a plan B if you have a business that has a strategy of burning a lot of cash in order to grow. So that would be my advice for entrepreneurs. And that's something that we are looking in our companies as well. How can we sort of make the runway longer with?
Yeah, I think, certainly in the US, we're hearing trying to get to a 36-month runway, cutting the costs. Like, what are you advising your founders at the moment to do? And obviously founders in the room today who obviously want to be prudent and resilient to what could be coming.
You need to be more pragmatic on when you're thinking, what milestones do I need in order to raise a Series A? So this sort of hype or we're going to grow eventually mindset, I don't think that's going to run really well in the future. So you need to be really pragmatic. You need to have revenue goals. You need to have product market fit goals and all that thought in a more concrete way than before. So that's something that entrepreneurs should think about. And of course, the runway,
Yeah.
If you're raising in the next 12 months, it's probably going to be
tough.
I'm not saying hard, but it's going to be more polarized than in the past.
Yeah. Dilek, what are you advising?
I think it depends which stage you are again. If you are early stage, the next milestone for you is product market fit. So how you are going to hit product market fit is, and how much money you need and how much do you need to burn. Obviously, you still need to burn. But if you are over Series A, then it's like, as you say, 24 to 30 months runway. Like if you are less than 2x growth, probably you will have a problem. If your gross profit is less than, let's say, 50%, it's going to be an issue. So increase your burn rate to 1x. So these are the things that we are talking to our founders. But to give you an idea, almost just 3 years ago, like the product market fit common idea was like $1 million ARR, which totally changed. So how you can hit that $1 million ARR as soon as possible with the least burn. But we know when the COVID started, Sequoia wrote about the Black Swan event. It was like the gloomiest days. Then we know what happened. Obviously, it's not going to be the same because we printed so much money. Inflation, interest rates are going up. But I always say, plan is nothing, planning is everything. So it's time to be more cautious about what you are spending.
Yeah, and obviously like in March 2020, we jumped back pretty quickly. If you had a crystal ball, how quick do we sort of bounce back now? Like, how long does this go on for?
So we have, if you look at obviously none of us has the crystal ball. but let's say if you look at the historical data, we have been here like during 2000s. Obviously, I was in college that time, but it took like 2.5 years to 3 years. It was all about internet companies boom. Without any company creating real value, it was all like eyeballs on the companies. So that created the bubble. It took, as I say, almost 3 years. Then we had it again during like a great recession, 2008 to 9. It was all about real estate, bubble and everything. It took like a year and a half. Now I think it's happened because of tech growth companies and the low interest rates for the last 10 years. So long story short, I don't have a crystal ball, but I assume it's going to take a year and a half or 2 years.
Yeah. What are your thoughts?
Well, I'm a bit too young to experience the dot-com bubble, but I think, if the chairman of the Fed says that inflation is transitory and most definitely is not, then that means that nobody knows where it's going. So always good to have a plan B.
Yeah. What sectors do you think are going to be hit the hardest? Where do you think you're going to see funding drying up?
Well, I think it's the same as in, you can draw some parallels in the public market. So when the cash flows are far in the future, those companies are going to be valued at less per now. So
the companies who their valuations projected on the future revenue are gonna hit the most, as we can see. And just to give you an idea, before, like, if you look back 5 years, in the software SaaS index was like 5x for the forward-looking 12 months. It was around like 35x for a while, for the last couple of years. So now it came down to 5 to 8x depending on your growth. So you need to have a real revenue, margins for sure.
Yeah, I think that's the biggest advice. As you say, getting to product market fit, getting to the revenue as quickly as you possibly can.
And also your customer base is going to be important too, probably.
So for like Series A and above, are you expecting US investors to be less keen on European startups, deploying more back into their own portfolio companies? I mean, do you think there's going to be a shift as to where the money can come from?
We had a conversation with a couple of VC friends from the region, let's say, and we were talking maybe there will be another scenario, which means now there are so much growth capital, and at their level, they don't have that many companies, and they were always valued based on their growth, not the real value. They might come down. If they come down, then the early stage valuations come up, like Series A, Bs, which is like in between till the growth. So there might be another scenario there for sure. On the US side, I think they will always come after the good companies for sure.
Yeah. What's your thoughts?
Yeah, so the US investors are quite opportunistic here, so I don't think they have the same sort of a foothold as European venture capitalists. So they're always going to be looking for good deals, and I don't think the good deals will suffer in valuation that much. So.
And maybe also in Europe, still valuations are lower than US. So there are always bigger arbitrage for them. So they might look more. So we don't know how the market is going to play, but obviously there are going to be different times ahead.
Yeah. Do you think government should be doing more? What do we think that government should be doing?
So we don't know what's planned yet, but obviously the war and politics will affect the field that I'm looking, so green tech and all that. So I'm expecting that the EU will really ramp up financing towards green tech and carbon capture and all that kind of stuff. In the future, carbon credits will be far more expensive. There will be different kind of carbon taxes and all that. So that will definitely drive the innovation in that field. And that's mostly, legal mandated and driven. Also by consumers, but by EU as well.
Mm-hmm. I think they should definitely do, because now, not just for the tech startups, but for SMEs, getting money or debt is going to be really expensive. So bringing money down is going to be crucial for the future couple of years.
Yeah, I agree with that.
Mm.
Then again, if you ask a fund manager whether there should be more money, of course, But yeah.
Good. I don't have the clock here, so I've got no idea how long we've got. But, I think this topic, with two great VCs in the room, are there questions from the audience? Because I think, I'd much prefer that founders get the opportunity to ask questions. And
I just have a question regarding cash. Don't you think that companies that currently have piles of cash, and most of them are technology companies, and their growth and has been moderated, they will step in and purchase early stage companies more actively and able to sustain valuations?
There might be. I think I love entrepreneurship, so this is my passion. Day and night, I work with entrepreneurs for sure, and I've seen couple cycles. So we don't know. I think the good part, really good companies are created during this time. I think good entrepreneurs always find their way to navigate these crises. Like, I think hiring is going to be easier. You can go and buy companies for cheaper. I think it all depends where you are and what you need and how you are going to pass through that. In Turkish, we say we throw water behind people when they are leaving. The reason is we want them to come back no matter what, without any obstacles. So we want them, good entrepreneurs are like waters. They come over, go up and go under and find a way to go over those obstacles, let's say. I can't say for sure, but I think there are going to be good things. There are going to be cheaper stuff or the good ones with the cash.
These tech companies that have all this cash, they're probably waiting for the valuations to go down, of course, because if there's no alternative for you, you only have one sort of party to go to and sell your business, then obviously that's going to affect the value of the company.
One more point though, like if you look at the stocks of high growth software companies last week, just like Snowflake, the sweetheart of the market, like doing billions of dollars, the valuation went down 50%. Still multiples are higher, almost 20-something X changing every day. But imagine those companies, the stock is going almost 1/10 of their valuation. Are they gonna work on their own company, or are they gonna go out and buy another company with the stock? Even they buy, it should be depressed valuations for sure.
Any other questions? Yeah.
So we always talk about powder at the VC funds and private equity funds, but is there any knowledge about the powder at the large tech companies, the large startups that have raised in the last 24, 36 months? How does that look like? That's a question.
You mean the cash in the startups?
Yeah. Following up on that, on the idea that there should be lower cost, quality targets, like M&A targets for the companies to buy. But then if there is a lot of powder at the tech companies, the startups have raised in the last 24 months, then there's going to be still a lot of competition, and then the valuations actually may not drop for these targets.
Yeah. So I don't know what's the situation as a whole in Europe, but if you look at the Nordics, last year 20 billion euros was invested into startups. But then again, it's hard to say how much money are those guys burning, how much is their actual powder. Now, if we're talking about dry powder, so how much money is still managed by VCs that hasn't been committed yet to investments, that is also at the all-time high. So things are good for now, but you don't know how many funds will raise in the next sort of 2 to 3 years. And that's the sort of dilemma that you go with. If you raise the good funding right now with a good valuation, then you might have to prepare for a similar valuation or a down round as well, if you're burning a lot of cash.
So that's a really good question. I need to go and look at that data. But without knowing the exact number, did you see the TechCrunch article on Tiger Global? They raised $17 billion fund and they almost spent all the money. And the companies are burning like crazy. So I have no clue what is the dry powder for startups for sure. But the ones with the cash, they are definitely gonna have a higher hand to play. I was checking Amazon. How did they survive .com bubble? And I realized if you look at their case study, they just raised money right before the .com burst. So I think having a cash is definitely worth it. And they tried so many experiments during that time when the hiring was cheaper, marketing was cheaper. So they were advantaged comparing to their competition, even though they were not the shining star in the bunch. So I think it's a really complex environment for now, but we will figure it out along the way.
I think the good news, and I'd love to hear your opinion, is actually corporates are still buying. So, revenue
less
for
customers.
Yeah, customers is not going away for good startups. That doesn't seem to be drying. I don't know if you've had a different experience.
Yeah, they're still buying. With corporates, it's always a question of how much depth do they have. And for example, if you look at the US, there are a lot of companies that are not actually generating any profits because they're servicing their debt. Now, if interest rates rise, then those companies will have less money to spend on external services and M&A and all that kind of stuff. So it will go down, but at what time rate, I don't know.
Yeah.
We are yin and yang. I think businesses are still delivering good numbers. If we look at the valuations are coming down, but metrics are going up.
Yeah.
So I think, and startups are helping them to make it cheaper, better, faster. So if you are a good product and helping your customer to make things better, I think you still have a lot of chance to have customers. Obviously, enterprise customers are the better segment to target, but it's going to take longer. But if you look at the .com time, they say Yahoo banner crisis. Yahoo was like a shining star growing really fast, but their most of customer base were startups. With the crisis, they all went down. So if you have so much exposure to startup world as a customer, I think that's going to be really high risk.
Any more questions from the audience?
No?
No? Yeah, please do.
Thanks. I'd like to ask about the IPO market. So now it's dead in the water. Some people think it's gonna start coming back already in the autumn. What are your opinions? What are the phases of IPO market coming back over the next 3 years or so?
So last year was if you look at Nasdaq in Stockholm and Helsinki, absolutely record-breaking year. I think there were 20 IPOs in Helsinki and 100 in Stockholm or something like that. And we did an IPO as well, like I said, a pre-revenue startup, Betolar, in December. Then the appetite was good. Now we have a potential other case going towards that, so there is still appetite, but the sort of level of expectation on the maturity of the technology and the time to revenue and all that kind of stuff, that has definitely gone up.
So I have a simple question for you. You have money, and for the last 10 years, you couldn't put it anywhere and didn't get any interest. So you would take high risks to make more money. But now you have guaranteed high interest option in hand, instead of putting your money in the risky bucket, which high growth startups were telling you, like in 10 years, I'm gonna be 10x, let's say. Which one would you do now? I think the liquidity is obviously out of the market for a while, for sure. People are gonna park their money in the interest part for sure for a while. So IPO, I think, is gonna slow down.
Same. I mean, look, I don't see it coming back up. If you look at where us VCs get our money from, LPs, institutions, endowments, they've been completely overexposed on the venture and the public market side. And, many funds in the US that were going to come out have delayed that. They're not going to come out and raise now. They don't think the environment's good for it. So, it's all going to trickle down until, it stabilizes a bit more.
But let's say for a startup now, like a late stage startup now, who was planning to do an IPO in 2026, let's say, which is that still a good plan, sort of, or do you see some fundamental changes of environment, and then again for someone planning an IPO for 2023, and now is it an active preparation phase already? Should they postpone or what should they do?
I mean, for me, preparation for an IPO is just good practice anyway. If you're going to head that route, I don't think any of us can say when it's going to when it's going to come back up. And if you even look at like things like Airbnb, they kept delaying for the right moment. So I think it's hard to say whether 2023 is going to be a good year to IPO, but I mean, I think just being ready and being prudent on that, I think sensible.
Yeah. And also, like, look at now. If you want to be a $1 billion company, you would make like 10 million ARR, forward-looking ARR, like last year, and you would get $1 billion valuation. Now you need to make like $178 million ARR to be valued as a $1 billion company. So I think it also depends what you want to do. Where do you want to raise the money? So I think I would stay private if I can. But it also depends on your options. So we also know at that dot-com bubble, so many companies went public because they couldn't get money from the private money. Yeah. Just the different perspectives.
I think it depends a lot on your company. What's your plan going forward? Are you cash flow positive? Are you generating revenue? How much? And so forth. If you raise public money and then you need more, then you're in trouble. Yeah, okay. So then you would have to think whether this is an exit or is it another financing round, because the more and more investors will demand that the founders have long lockups and all that. So for the founders, it's most definitely not going to be a liquidity event. So plan accordingly.
Yeah.
We've got another question down the front.
Yeah, so just a question about interest rates. It's indeed true that nominal interest rates are increasing, but the real rate is actually still negative. Doesn't that suggest that funds should be investing their money instead of sitting on cash?
Yeah, I wouldn't sit on cash as long as the real rates are negative, of course. But you know, when Fed raises the rates, I think it's more psychological. Nobody looks at the real rate. Nobody knows what inflation actually is. So it's always a bucket of things, right? So hard to determine, but I guess real rates are still down like -5% or something like that.
So I'm going to give you like a real sense. Probably a lot of funds are going to keep investing at the early stage till they fundraise. And it will depend on how easy are they going to be able to raise their next fund. I think that's going to trickle down a lot, for sure.
That's what I think is going to be the big trigger.
Yes. And
Is
also
that most of them are delaying coming out. So even funds that needed to go raise this year are not raising, or they're raising smaller than they anticipated. That's going to be the big trickle.
As a fund manager, it's all my psychology. Like, I want to deploy that money. I want to find amazing founders and put the money in. But if I can't raise the next fund, I need to be more like cautious, for sure.
And I guess you need to remember that this is usually a 10-year-old or 10-year commitment to a fund. So if the real rates are negative now, what will they be in 5 years?
One more question. Yeah,
Question,
great. Just gonna make...
Thanks, inspiring. My name is Richard. Danske Bank, who is the second largest bank in the region, with Deal Room, came out with a report last year on 2020 figures, and there was 27.5% of all VC capital in the Nordics went into impact startups, and in Sweden it was 45%. And I know they're coming with a new report here in late June on that. How do you see the probability that those companies now scaling up, like you have Ironride in Sweden or Too Good To Go in Denmark and so on, that their probability is larger than others?
So I believe that in its core, sustainability is the best kind of business model there is, but obviously you have to fit that into the real world and actually scale your business and generate revenue and all that. So, and of course, my focus area is green tech, so impact startups, please call me. I think there's going to be a lot of public funding. There's going to be a lot of new funds that are backed by the EU that have these impact criteria. So that's definitely something that's going to be more and more, we're going to see on top of financial KPIs, we're going to see these impact KPIs that are required by the startups.
So I would say what impact means matter a lot. Tesla is an impact company too. So as I say, I think adaptability for the next couple of years and creating real business value is going to be really important if you are not getting government grants for sure.
Thanks, everyone. I'm going to wrap up because I've been told we've gone over. So can I have a big hand for our guest today? Super interesting.
Thank you.